Hello, Matthew Bell with InsurancePrescription.com. In response to COVID-19, the U.S. Congress has passed the CARES Act, which stands for the Coronavirus Aid, Relief, and Economic Security Act. And this act contains numerous provisions in it that modify, at least temporarily, certain restrictions and on accessibility for various retirement accounts. Not only do these changes impact retirement savings, but they also bear on conversations about how to make ends meet in the interim if you find yourself in a hard place. For example, if you find yourself unemployed or find yourself with a reduction of income due to the coronavirus. Let me just go through some of the changes that the CARES Act makes temporarily in terms of retirement savings vehicles. The usual disclaimer, I am not a tax preparer, I'm not a financial advisor, so I can't give you specific advice. This is presented in good faith for general informational or entertainment purposes only. If you need specific advice, you need to consult an advisor in your area, for example, a tax preparer or somebody from your human resource department or from the company that acts as custodian for your 401k or other retirement vehicle. As a preface to this, retirement vehicle in this context generally has to do with things like defined contribution plans that you might have through your work, 401k, 403b, 457b, or other tax qualified individual retirement accounts like the traditional IRA. And the idea is when they're designated as retirement vehicles in the relevant sense, the IRS gives you certain breaks, for example, tax deferral that you wouldn't get if you were invested in another vehicle. So if you are in a CD, you're going to get 1099 every year for the interest. But if you have tax deferral capability, then your money is able to grow a little more quickly. So it's an advantage in that sense. However, those advantages come at a cost. So when we're talking about a retirement vehicle, the IRS places restrictions not only on how much you can put in, so there are contribution limits, but also on the period of time during which you have access to those funds. So the IRS has prescribed that retirement accounts cannot be withdrawn from before the age of 59 and a half, at least not without a penalty in most circumstances. There are some very complex structured plans that enable you to get funds out of a retirement account prior to the age of 59 and a half, but those are beyond the scope of the present video. So at the age of 59 and a half, you may start taking money out of a retirement account. Now that doesn't mean you have to be retired. You could be waiting for the age of 62 when you have access to Social Security. You could be waiting for 65 when you have access to Medicare. You could be waiting for 67 when you have full retirement benefit access, or even 70 when you have access to the maximum Social Security benefit. It's simply an arbitrary, really, pronouncement on the part of the IRS in terms of when they're going to allow a penalty-free withdrawal starting at age 59 and a half. So with that background, we can say a few things. The CARES Act, number one, has waived that 10% penalty if you are under the age of 59 and a half. That means that you have access to retirement accounts even if you do not fit the definition of a retired person according to the Internal Revenue Code. In addition, number two, typically for a withdrawal that is made before the age of 59 and a half, the IRS requires that 20% be withheld in taxes, so a 20% withholding. That has been reduced to 10%. So now not only is there no penalty, you still got to pay tax on a withdrawal, but there's no penalty for an early withdrawal. But in addition to that, you do not have to have 20% withheld for taxes. You only have to have 10% withheld. Number three, the tax bill that would be due, whatever the taxes are that you would owe on that distribution, can be spread out over the course of 3 years, according to the CARES Act. So that means you don't necessarily have to take the entire tax hit the year you take the withdrawal, but you can spread it out. Now again, a penalty is different from taxes. So the fact that there's no penalty on an early withdrawal does not mean you get the money tax-free. If it is in a tax-qualified tax-deferred plan like a 401k or a traditional IRA, then you do owe tax on 100% of your withdrawal at whatever your income tax rate would be. Now, number four, the maximum the CARES Act allows you to access as a withdrawal is $100,000. Now, incidentally, you can take that money as a withdrawal from your 401k, or you could take the money as a loan. So previously, the loan limitations were $50,000 or 50% of your retirement balance, whichever was less, but now it is $100,000 or 100% of your balance, whichever is less. Loans are taxed differently, so in a loan situation, you don't have a liability unless you default on the loan. But again, consult a tax preparer for specific advice. Now, number 5, the money that you do take out, you can put back in, and that is going to be irrespective of the usual contribution limits that are in place. So generally speaking, the IRS has contribution limits on various retirement plans, and I get into this in another video. I'll put the link in the description. I'll put the screenshot up. But in general, you have limitations on how much you can put in. If you're going to be restoring the money you took out, the IRS is, they have said, going to allow that. So you'll be able to take money out up to $100,000 and then put that money back in if you're able to in going forward. I think the time limitation on that is the same 3-year period over which you can spread your tax liability. Number 6, in order to qualify for this, you have to report that you have been adversely affected by the coronavirus. However, I don't believe that any third-party certification is required. I think they're accepting self-certification or self-reporting. Now, number 7, you have all the way until the end of the year, so that is December the 31st of 2020, in order to take advantage of this type of withdrawal if it is of interest to you and if it makes sense for your plan. A little more on that in a few minutes. Number 9. Earlier I said that the IRS begins to allow you to take money out at the age of 59 and a half. If you have a qualified retirement account, you may start taking money out once you hit 59 and a half. But you must start taking money out once you hit a particular age. That's called the required minimum distribution beginning date. And in the past, that was age 70 and a half. However, since the passage of the Secure Act in 2019, and I have a video where I get into that, the age has been changed. It's now 72. However, this year, because of the coronavirus, the CARES Act has provided that the RMD, or the required minimum distribution, is temporarily waived. So you do not have to take it this year. Now, there may be reasons why you would still want to take it this year, but that's beyond the scope of this video. I invite you to see some of the other treatments that I have on this question. And finally, number 10, if you fall into the situation where you are a beneficiary to somebody else's IRA, so you have an inherited IRA, and under the previous rules you are taking distributions over a 5-year period, the IRS has provided that you get 1 additional year. So you do not have to take the required minimum distribution for your withdrawal this year. If you're on that 5-year rule, you can not take it this year and then get an additional year tacked on. So the CARES Act, once again, provides now for some loosening of the restrictions. One article I consulted compared it to money inside of a safe. And when you have money in a retirement vehicle, it's basically held in custody for you. These are called custodial accounts, so you don't have unfettered access to the money and you can't just put in whatever you like. But for the time being, according to one metaphor that I saw, the IRS is basically allowing that safe to be open so you do have access to that money if you need it. Now, having said that, realize that if you take a withdrawal from your 401k, you are almost certainly going to be putting your retirement plans behind. That might be true, but for some people you might be over a barrel financially. If you've lost your job, drawing from the 401k might be the only game in town for you. And if that's the case, of course, you have access to this money and you should take advantage of the provisions that the government is now allowing. However, if you have other options, you might want to think very carefully about pursuing those other options before you put yourself at a disadvantage, because money that you take from a retirement account is you're not just losing the money, but you're also losing what that money might potentially do for you in terms of rate of return or market gain. Now, the flip side of that is, since we have seen a 20, 30, 40% drop in some sectors in terms of the market based on the coronavirus and the ensuing response, for many people, taking money out now would be what they refer to as realizing a loss. So a second reason why a person might hesitate to take money out of the 401k at this time is because they do not want to sort of concretize the losses that they have experienced in the market. Once again, just to repeat, I cannot give you specific advice, but if you found something of interest or of use in this brief overview, I do ask you like the video, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today. I wish you well, and I look forward to seeing you again in another video. Thank you.